The automatic contribution had already come out of his paycheck before the property tax draft cleared overnight. He noticed it while scrolling through his banking app in the early light of the kitchen. The house still quiet, the dishwasher humming from the night before. The retirement deposit posted every 2 weeks without interruption. It had been doing that for nearly 15 years. At 46, he had not missed a contribution since his early 30s. The percentage had gradually increased with each salary adjustment. What began as a modest deferral had grown into a disciplined line item, one that HR congratulated him for during annual benefits enrollment. He had always selected the higher rate. It felt responsible, predictable, aligned with the idea of a stable financial life. Across the same period, the mortgage payment rose once when they moved from a starter home to a larger property in a different school district. The payment never went down again. Insurance premiums climbed in quiet increments. Property taxes recalculated every few years. Utilities fluctuated but trended upward. The retirement percentage also rose, but it rose by choice. His wife's income followed a similar pattern. Steady employment. Employer-sponsored retirement plan. Gradual increases in contribution rate. Both accounts grew in parallel, invested in diversified funds selected during onboarding years ago. Neither of them revisited the allocation often. It seemed unnecessary. The balances were climbing. But so were the fixed obligations attached to the house, the cars, the insurance policies, and the student loans they had taken on behalf of their oldest child. The loans were federal, structured, predictable. They would run for years. At work, he had become mid-level management. Stable salary. Annual cost of living increases that rarely exceeded inflation by much. Performance bonuses that varied but were never extreme. His compensation appeared solid on paper. Colleagues described him as financially secure. He owned a home in a desirable suburb. He maxed out his retirement contributions. He carried no credit card debt. Yet most months ended the same way, with little discretionary margin left after everything cleared. The retirement contributions never felt negotiable. They were set before take-home pay ever appeared. They reduced what was visible in checking. In that sense, they were easier to maintain than other expenses. The obligation existed upstream, hidden from daily spending decisions. The house required downstream payments that were visible and immediate. Mortgage, insurance, property taxes held in escrow but recalculated. Maintenance that arrived unpredictably. A roof replacement. HVAC servicing. Exterior painting required by neighborhood standards. None of these expenses were optional once the house was purchased. They accumulated quietly across years. He often reviewed the retirement account performance late at night, after the household had settled. The market had delivered long stretches of growth punctuated by downturns that briefly erased gains. Over time, the line moved upward. Compounded returns layered on top of steady contributions. The total balance crossed milestones that once felt distant. Crossing those milestones did not change the structure of his monthly obligations. Their second child entered high school the year his retirement account passed a significant threshold. The balance was large enough to suggest future comfort. It was not large enough to replace his salary anytime soon. College planning resumed, this time more carefully, informed by their experience with the first child. Savings accounts designated for tuition were already partially committed to future semesters. The retirement accounts were legally protected and structurally inaccessible without consequence. The college savings accounts were more flexible but purpose-bound. The home equity existed on paper, subject to market conditions and interest rates. Most of their wealth was illiquid or restricted. Liquidity resided in their checking account, which oscillated within a narrow band. He had once believed that increasing retirement contributions would create a widening sense of financial ease. Instead, the contributions grew alongside every other category of fixed spending. Health insurance premiums rose as his employer shifted more cost to employees. Deductibles increased. Out of pocket maximums reset each year. None of these changes were dramatic on their own. Over a decade, they accumulated. There was a year when he briefly reduced his contribution rate to cover a period of elevated expenses. Unexpected medical bills, a car replacement, higher than anticipated tuition. The reduction felt temporary, almost corrective. Within 12 months, he restored the previous rate. The retirement balance resumed its projected growth path. The mortgage amortization schedule, however, moved slowly. Even after years of payments, the principal declined gradually. Interest comprised a meaningful portion of each installment well into midlife. Refinancing had once lowered the rate, but it also extended the term. The house would not be fully owned outright until his early 60s. Retirement eligibility under his employer's plan and social security projections hovered in a similar time frame. The alignment was tidy on paper. House paid off around the same time retirement became feasible. In practice, the years between 45 and 65 were dense with overlapping obligations. College tuition overlapped with peak earning years. Insurance premiums peaked as well. Healthcare costs tended to increase with age. The retirement accounts grew, but so did the need to continue working in order to sustain all parental commitments. At 50, he attended a benefits seminar offered by his employer. The presentation outlined projected retirement income based on current savings rates. The model assumed steady contributions and average market returns. It did not model tuition payments, rising property taxes, or extended support for adult children returning home after graduation. Those realities were external to the projection. He left the seminar reassured by the chart, but aware that the chart did not capture the full household balance sheet. His wife occasionally mentioned the idea of scaling back work earlier than 65. The thought remained abstract. Their monthly obligations did not permit reduction in income without structural change. The retirement accounts, though sizable, were designed for a later chapter. Accessing them early would introduce penalties and tax consequences that undermined their purpose. In their late 40s, they upgraded neither vehicles nor lifestyle. They traveled occasionally, within limits. Vacations were budgeted carefully. They avoided large discretionary purchases. Most financial decisions were filtered through the lens of maintaining contribution rates and meeting fixed expenses. The appearance of financial strength persisted. Net worth statements, when calculated annually, showed growth driven by home appreciation and retirement balances. The figures suggested upward mobility. Yet the cash flow available each month remained constrained by design. He understood that retirement savings were compounding in ways his checking account never would. That knowledge provided long-term reassurance. It did not reduce the immediacy of monthly drafts clearing in sequence. Mortgage, utilities, insurance, tuition, groceries, transportation, property taxes, charitable donations, subscription renewals. Each category had a rationale rooted in responsibility. There were conversations about downsizing once the children left home. Those conversations were postponed repeatedly. The house was tied to school districts, community networks, and the practical reality of hosting adult children during transitional years. Selling would release equity, but it would also require relocation into a housing market with its own pricing pressures. Meanwhile, retirement balances crossed additional thresholds. Market volatility introduced brief periods of decline that unsettled him more at 52 than at 32. The numbers were larger now. A 5% swing represented a significant dollar amount. He did not alter allocations. He continued contributing. The realization arrived gradually rather than suddenly. Retirement savings were functioning as intended. They were building a future claim on financial security. Simultaneously, they were competing with present obligations that were equally non negotiable. The competition was not visible in any single statement. It existed in the tension between illiquid assets and monthly cash flow. He could not pause property taxes to increase retirement contributions further. He could not pause retirement contributions without affecting projected income decades later. Both streams ran concurrently. At 55, his salary peaked within the company's compensation band. Future increases would likely be incremental. Tuition obligations tapered as the youngest approached graduation, but healthcare costs for aging parents entered the picture. Support was modest but recurring. Travel to assist them required time and money. The retirement accounts, now substantial, remained untouched. He began projecting scenarios in spreadsheets late at night. If contributions continued at the current rate until 62, the balance would reach a target that approximated a comfortable withdrawal rate. If he reduced contributions slightly, the balance would still be adequate but less robust against market downturns. Each scenario assumed the mortgage would be paid off on schedule. None of the projections altered the present cash flow reality. Their home required another significant repair in the same year. That insurance premiums rose sharply due to regional claims activity. The increase was not personal, but it was applied to their policy. The monthly escrow adjusted accordingly. Retirement contributions remained fixed. The structural nature of their finances became clearer. Large portions of income were pre-committed years in advance through decisions that had seemed prudent. Purchasing a home in a stable district, funding college, maximizing tax advantage retirement accounts, maintaining comprehensive insurance coverage. Each decision aligned with conventional markers of financial responsibility. Together, they created a system in which most income was allocated before discretionary spending entered consideration. At 60, he would likely still be contributing to his retirement plan. The account would continue compounding. The mortgage would be close to extinguished, but not entirely gone. Social Security eligibility would approach, but not fully replace employment income. Healthcare coverage would shift in structure, but not necessarily in cost. He imagined the first month without a mortgage payment. The freed cash flow was noticeable in projections. He imagined the first month without retirement contributions as well. That scenario felt less likely. After decades of automatic deferrals, the absence of that line item would signal something final. His career remained stable. Layoffs had occurred in other departments, but he navigated through them. Stability was not accidental. It was cultivated through cautious professional choices that mirrored his financial decisions. No abrupt changes, no speculative leaps. The retirement accounts were the most visible evidence of long-term planning. The house was the most visible evidence of stability. Both required continuous funding for decades. There was no singular moment of regret. Only a recognition that long-term financial responsibility often meant sustaining parallel obligations for longer than expected. Retirement savings did not eliminate present commitments. They existed alongside them. In the quiet kitchen before sunrise, He sometimes reviewed the transaction history again. Payroll deposit, retirement contribution, mortgage draft, insurance premium, utility payment, tuition transfer. The sequence repeated with minor variation each month. The balances grew in the background. The obligations persisted in the foreground. Neither cancelled the other out. He closed the banking app and set the phone down on the counter. Outside, the neighborhood remained still. The house, partially paid for, stood as both asset and liability. The retirement accounts, steadily compounding, stood as promise and restriction. His paycheck, though substantial, continued to flow immediately into structures built years earlier. The competition between future security and present responsibility was not dramatic. It was administrative. It was procedural. It was embedded in automatic transfers and long term contracts signed in good faith. By the time he turned off the kitchen light and prepared for work, the retirement contribution for that pay period had already settled. The property tax adjustment would post next week. The mortgage draft would follow. The accounts would continue to grow. The obligations would continue to clear. And the distance between them would remain measured not in months, but in decades.